Hey everyone, so what if I told you that the secret to a company's success, that thing that makes it last for decades, isn't always the product? It's often something you don't even see. Today, we're going to pull back the curtain on one of the most powerful and most overlooked competitive advantages a business can have.
You've seen this happen before, right? Two companies come out with these amazing, game-changing products. One of them becomes a legend, a household name, and the other one, well, it just kind of fades away. What's going on there? What is that secret ingredient that separates the winners from the ones that get forgotten?
I mean, just look at this. You've got Company A, an absolute market leader, crushing it. And then there's Company B with the exact same great product, and they're just struggling to keep their head above water. So, it's pretty clear that just having a cool product isn't enough. Something else is going on under the hood.
And here it is. This is the answer. The secret weapon, that hidden advantage, is the company's distribution. It's not about what they make, it's all about how they get that product into your hands. This is the invisible engine that really drives long-term success.
Okay, so what are we actually talking about when we say distribution? Let's break down exactly what a distribution channel is, because once you get this, you'll start seeing it everywhere.
So in the simplest terms, it's the entire journey a product takes, from the moment it rolls off the assembly line to the second you, the customer, are holding it. That whole path, every step of the way, that's the distribution channel.
And these pathways can look totally different. You've got direct sales, that's like buying a computer straight from the company's website. Then you have retailers, the actual stores you go into. Wholesalers are the middlemen who buy in huge quantities to supply those stores. And of course, you've got massive online platforms and even franchise networks, like all those fast food joints we know. All right, so why should we care? How does this actually help a company make more money? Let's dive into the 6 big financial payoffs that turn a boring old distribution network into a powerful, protective moat around the business.
First up, and this one's a big one, revenue stability. We're not just talking about having a good quarter. We're talking about creating a steady, predictable flow of cash that you can count on for years. It's literally the foundation of a solid business.
When a company has its distribution locked down, think about a big soda brand that has guaranteed shelf space in every single grocery store. Its sales become incredibly reliable. And let me tell you, investors love that kind of predictability. They reward it with a much, much higher price for the company's stock.
Okay, the second payoff is massive for profits. It's all about lowering the cost to get a new customer, what the pros call CAC, or customer acquisition cost.
It just makes sense, right? If you've got an exclusive deal with the biggest retailer in the country, you don't have to pour millions of dollars into ads to find customers. They're already walking through the door. And this is where the magic happens. Your profits can absolutely skyrocket, growing way faster than your top-line sales.
Advantage number 3 is what I like to call the holy grail for any business: pricing power. This is a company's ability to set its own prices without constantly having to offer discounts or get into those brutal price wars with competitors. And the master of this is Apple. Think about it. By having their own retail stores, they control the entire vibe, the experience, and most importantly, the price tag. You'll never walk into an Apple store and see a fire sale on the new iPhone. That protects their brand, and it keeps their profit margins incredibly high.
Fourth on our list, a solid distribution network creates something called high switching costs. Basically, it makes it a huge pain for your partners to even think about leaving you for a competitor. It makes your business really sticky. And we're talking about more than just a good relationship here. This is when a company's inventory, its payment systems, its entire supply chain is woven directly into their distributor's operations. To rip all that out and switch to a new supplier? Oh, that would be a total nightmare, both financially and logistically. That integration basically locks in your market share.
Now for number 5, and this one is a bit more advanced, but it's a financial superpower. It's all about leveraging something called working capital.
Okay, this sounds complicated, but the idea is actually beautiful. See, most companies need to have cash ready to pay for their daily operations. But some giants, because they have so much power over their distribution, actually achieve negative working capital. This means they get cash from you, the customer, right away, but then they might wait 90 or even 120 days to pay their own suppliers. It's like they're getting a free loan to run their business. It's an incredible advantage.
And the final payoff, number 6. A fantastic distribution network builds a fortress around your company. It creates these huge barriers that make it almost impossible for new competitors to get in and challenge you. Just picture it. You've signed exclusive deals with all the best distributors. So what's a new startup supposed to do? They're stuck with 2 awful choices:
They can either spend a fortune and waste years trying to build their own network from scratch, or they can slash their prices to the bone just to try and get a foot in the door. Neither of those is a great path to success.
Okay, so we know what this moat is and we know why it's so powerful. But how can you, as an investor, as an analyst, how can you actually spot this thing in the real world? Let's get practical and make a little checklist.
All right, here's your cheat sheet. When you're digging through a company's annual report and you see the phrase exclusive agreements, your brain should immediately go, aha, that means stable revenue and lower marketing costs. If you see that they own their own stores, you should start hunting for higher gross margins in their financial statements. And if you find a negative cash conversion cycle, bingo, you found that amazing working capital advantage we were just talking about.
So let's bring this all home. We've gone through 6 huge advantages, but what's the end game here? What's the ultimate prize for a company that puts in all the work to build this incredible distribution moat?
It all boils down to this single idea. When two companies with pretty much the same product go head-to-head, the winner isn't the one with the flashier design. The winner is the one with the better system for delivering that product. They take over the market, and they make way more money for every dollar they invest in their business.
So I'll leave you with this question. The next time you're looking at a company, don't just get wowed by the shiny new product. Look deeper. Look for those invisible pathways, those exclusive contracts, those deeply integrated relationships, because that's where you'll find the real, lasting advantage that separates the true winners from everybody else. Thank you for watching, friends. Before you go, do me a favor and drop a comment below. Let me know which stock or which sector you'd like to see me break down next. I really do read all of your comments. And remember, here on your analyzer, we don't just talk about stocks, we also get into the nitty-gritty and explain every fundamental ratio in detail so that you can feel confident analyzing companies all on your own. So for more deep dives and market insights just like this one, make sure you subscribe to the channel now. And don't forget to hit that bell icon. Thanks for watching, and I'll see you in the next one.
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.